Alrighty, good afternoon, everybody. Welcome to the Wednesday webinar, Weekly Market Talk with Dan Sheridan. Glad you can make it here today. And let's jump in, look at a few things. We'll look at a couple different strategies. I'm going to look at two strategies today. Two strategies maybe a lot of you have never done. So it may be two new strategies, or maybe these two strategies might be something you've done and maybe you had some questions on them. I'll go over them. One is a short diagonal, one is a ratio backspread, and I'll explain to you why those are interesting strategies for the environment we're in today, why I'm considering them today, these types of trades. The other thing, we'll take a look at the market and make a few comments on things. So it shouldn't be too long, but about a half hour. And let's, as they say, well, let's jump in. All right. First, before we jump in and look at some trades, I just want to get the few announcements or some information for you. And just to let you know two things. Number one, it's not too late to get in on the we have a new online 3-week online class, our last one of the year. It started Tuesday. Second class is tomorrow, and then there'll be 2 more weeks. And we're basically giving, these are for covered right and cash secured puts, people who do those type of strategies, but we're giving you alternatives, much cheaper and more efficient and much better potential yield strategies. So we're tweaking some of your favorites, the covered right and the cash secured put, to make them much more efficient, less capital involved, and better yield. So that's a really good class. We did the first class Tuesday. We do a live trade at every class to illustrate what we're doing, and we're teaching you the risk management and everything involved to help you practically be able to do it. So tomorrow's class starts at 1 Central. It's recorded. If you'd like to jump on in that, you could just go to the front page of our website and click on the button. And that's the first one, is the class, the online class. Second thing is, for people that would like to, hey, I'd like to try the cooking. Dan's cooking for a month and see what those guys are doing. His teaching, his trade ideas, his risk management stuff. You know, what is Dan doing in there? Here's an opportunity for you to do that. For $49, you can join for a month. Our new basic program, which would be about 2 to 3 hours of live sessions during the day. It's all recorded if you're working. And Mark Fenton does an hour. I usually do an hour. And then Mark does a opening bell right before the market opens. What's going on? What is he looking at? Trade ideas and stuff. And then we each do one, and we talk about, which is nice. It's not just trade ideas. It's more trade ideas within how we look at them at Sheridan Mentoring. We do teaching, some trade ideas, but we focus a lot on the risk management, the why behind it. Try to help you develop into a craftsman. So that's something you can take advantage of and encourage you. We've never done that before. I don't know how long I'm going to continue with that to do that, but I think it's a good opportunity for you to try the cooking. And for $49, it's not just, you know, a little newsletter that comes shooting out. This is teaching trade ideas, so you're understanding the why behind it. And so you're talking 2+ hours a day, like 40 to 50 hours over a month. So I think that'd be something to avail yourself of. All right, so let's go back to, let's jump into my Think or Swim here. We're going to talk about 2 strategies today. The first one And they're both strategies I would consider in this environment. So first one is a short diagonal, which I would call an alternative to a credit spread. And here's where I'm using Thinkorswim here. Here's where the underline is, an SPX. It's a chart of SPX. The green graph will be the expiration graph. A purple graph or line will be how the trade looks today. SPX is at 31.16. And so the trade is I am buying one going all the way out to January 17, 31.95 calls. And I'm going to sell one January 3rd, 31.70 call. So if this were a credit spread, what's a credit spread? Let's say we're going to do a call credit spread. A call credit spread would be we might sell here a January 3rd, 31.70 call, and we'd buy a further out of the money call against it in the same duration, right? Is everybody familiar with what a call credit spread is? Yes? No? Everybody familiar with what a call credit spread is? Yes. So when the option volatilities are lower, or like today, with VIX dropping 1.5 points today, getting in the 1440 level, and if you think volatility will continue a little bit, and how many people think that with the SPX about 40 points from the all-time high in the history of the universe, and based on Mondays and Tuesdays activity being down, how many think that over the next couple of weeks we could have some two-way and possibly some more downside? Does anybody believe that? Being 40 points off the all-time highs, anybody maybe a little bit concerned about the downside and maybe like to have something on it that doesn't have much risk or could benefit on the downside? And so this strategy, called a short diagonal, is simply an alternative to the way I'm structuring it here is alternative to a credit spread. And this short diagonal that I'm doing today is an alternative to a call credit spread when I'm concerned about the risk on the downside, and maybe I think the implied volatilities will go up, right? And so if you look at this, I'm selling a 31.70 call, right? I'm selling the 31.70 call, which is over 50 points up from where we currently are. And again, have we ever been the 31.70 in the history of civilization? In the history of the universe, have we ever been the 31.70? Yes or no? Have we ever been the 31.70 in the SPX in the history of the universe of the universe? No. So if I'm selling the 31.70s, and again, if it was a credit spread, normal credit spread, I'd buy the Jan 3 31.95. So why am I doing this? Well, it lets me do something where I'm long Vega, so I can benefit if volatility goes up, which happens when the market goes which way? When the market goes which way does implied volatility usually go up? And when it goes down. Question says from Robert, is this a debit spread? It's not. If it means, are we paying a debit for this trade? Yes. Is it a debit spread? No, a debit spread would be more what I would think of a debit spread if I buy one 100 call, and I sell one 110 call. I'd call that a call vertical debit spread, right? That's what I would call a call vertical debit spread. So is this what I'm doing today, a call vertical debit spread? No. Is it a debit? Meaning, am I paying a debit versus a credit? Yes. Why am I paying a debit? Because the one that I'm buying is more expensive than the one that I'm selling. So is it a debit spread? No. Are we paying a debit? Yes. Is this an alternative to a credit spread, call credit spread? Yes. When would I do this type of a trade, the call one? I think the implied volatilities are going up, and I think the market could be going down, right? Or I'm concerned about the risk on the downside. So you can see here, and I'm going to show you this a little bit more, it is little or no risk on the downside. Now I structured this trade only 3 delta short. I have a positive 9 theta. Because again, I'm selling the Jan 3rd. So this is about a 30-day trade with 30-day expiration. My shorts are 30 days from expiration. My long Jan 17s are 44 days from expiration. But I want to walk you through this trade, folks. Right? The debit of this trade would be about $1. It's going right now for $1.10. So the debit of this trade right now, again, I didn't put it on yet, but if this is the underlying 31.17, the short strike I'm selling would be the 31.70. The debit right now is going for around $1.10. $1.10 debit. Now, is the margin on this trade the debit? Is your risk or margin the debit on this trade? Yes or no? Is the risk or margin the debit? The answer is no. 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 In a calendar, your debit is your risk, but your margin is always going to be your risk of the trade. So if you look at this trade, is there more than $100 of risk on the upside? The green line is how the trade looks in 30 days. If you look at the P&L, is there more than $100 of risk on the upside? Yes or no? Is there more than $100 of risk on the upside? Yes or no? Here's the P&L. These are minuses. Yes, there's quite a bit more risk. Very little risk, if any, at expiration on the downside. So as you look at this trade, what I want to point out a couple things is, as we said, this is the short options are Jan 3rd. This is a 30-day trade. What I want you to see is this. Focus on this. The purple line is how the graph looks today. The green graph is how it'll look in 30 days. And so what I'm going to do is I'm going to go forward ahead in time, 5 or 7 days at a time, so you can see how that purple line changes over time. So here we are today on the December 4th. If we go 1 week into the future, what do you see? 1 week into the future, this purple line starts to rise, doesn't it? On the downside, if this is the underlying price here, 31.16. How about if we go 2 weeks into the future on this 30-day trade? Here's 2 weeks into the future, and what do you see? Again, if this is the price, 31, almost 17, does that purple line pump up the value? Does that purple line pump up as we go down? Yes, right? So you can see that purple line represents around depending on where we're at on that, but if we're near the current price, we're on $170, right? So $170, and the capital required for this position, if you look at the upside risk, is about 2,300. So if you took 170 divided by 2,300, you've got about 7.5% return in this area over the next 2 weeks. And that's what I would be looking at. Now, I set this up pretty close to delta neutral. If we go back to today, relatively close to delta neutral within 3 deltas. Here's my theta. So that's kind of the look of this spread. Give you a quick look at this. Any other questions on this? Just wanted to introduce something I'm looking at in this market, this type of trade, because of the 2 reasons I mentioned, being up at near the all-time high, something that would eliminate risk on the downside, actually make me some money on the downside, but I don't have, I've got some room on the upside, and but if I'm looking for maybe the volatility to increase a little bit, here's something I would consider. Yeah, I don't have time for the whole plan, but it just, do you need much of a plan for the downside? Yes or no? Look at the graph and tell me, does fear come into your heart on the downside? Yes or no? Yes or no? No. So really, the plan would involve, at least what you should be concerned with, where is the risk? Upside or downside? Where is the risk? Up or down? Up. So with us at 31.16, one of the things I could do here is we start moving, probably if the short strike is 31.70, as we start to get around here, maybe 15 points from the short strike. So up in this area, like 31.55. If we were to get up to like 31.55, at that point, what might I consider doing? I might buy in my short 31.70, right? Buy in my short 31.70 and sell a strike 10 points higher at 31.80 in that Jan 3rd expiration. So that would probably be the only plan I would do it. I wouldn't really have nothing much for the downside, but the upside I would just put an alert maybe 15 points before the short strike. All right, the second strategy that we'll look at is a ratio, out of the money ratio backspread. There's many variations of this. I'm just sharing one variation that I'm looking at in the current market. The other trade that we looked at was positive theta. Time decay would benefit us. This is a little more speculative strategy that we're looking for a move one way or the other. And this would be in the speculative part of the portfolio. So again, if I think either the market could shoot up or go down, and I think maybe the volatility could increase, if I'm looking for two-way movement or I think it's going down, this is a decent strategy. And what's nice is it's the way I've structured this, it's delta neutral. So if you look at this here, buy 2, sell 1. Again, we're at 31.17. Buy 2, January 3rd, again, 30 days out, 3,200 call. Sell 1, Jan 3rd, 31.60 call. So I'm selling my short call how far out of the money from the current price? I'm selling my short call how far out of the money from the current price? About. How many points? About 43, right? The underlying is 31.17. I'm selling the 31.60s, right? Isn't that about 40 some points out of the money, correct? We're selling the 31.60s. SPX right now is at 31, almost 31.17. So 31.60 from 31.17 is 43 points, right? So again, this would be called an out-of-the-money call ratio backspread. And so you can see in the T+0 graph, if we go up from here, we can make money. But if we go down, it doesn't show it here. We go down, you'd make money. You say, why? And you'll make more than you think. You're doing this for a $6 credit. So you'd get that entire $6 credit on the downside. So this is the type of strategy if you're looking for some movement one way or the other. Another strategy that I would consider in this environment, and it's delta neutral. You know, we're not sticking our head out on this. But we do need movement because it is negative theta. Decay is against us. And my plan would be on the downside, I'd do nothing. I'd go to, on the downside, I would go to my ATM machine and say, let's see, do I want to take out how much? How much, right? That's, a downside is I'd want to get some of my credit, right? On the upside, only thing on the upside is, as you can see at expiration, if we're in this kind of sea of death, up near 3,200, the P&L could sag there. Now, first of all, have we ever been to 3,200 in the history of the world? In the history of the world, have we ever been at near 3,200? No. But what I would do is just, again, I have no risk on the downside. The upside, all I would do, again, we're at 31.17. If we even get near this sea of death here, right? If we get up, I would just set an alert at maybe 31.60 or something, right? 31.60, somewhere around here, before we get into the sea of death, and take a look at the trade, right? At 31.60, if we got up there, I'd probably close out the trade, maybe a profit or a small loss. But as long as you're not, you're really risking this trade is just in this area, probably over 31.60. No risk to the downside. But we want this to move. If this does go down, I would take some profits, especially over the next couple days. So I would look to probably be in this trade, 30-day trade, no more than a week. Get my money and run. So those are two strategies, well, different strategies. Maybe some of you may not be too familiar with, but a couple strategies I was just thinking of today that I would do in a market environment like this. So I want to encourage you, sign up for the $49 for the first month for our basic program. I might have to change the name of the basic program. It's really not basic, right? There's nothing basic about the basic. Basic just means it's basic compared to the other two programs in terms of what you get. But, you know, you're getting most of the material is probably intermediate and higher. There's the nice thing for people who are more beginners is we put the trades on, we walk you through it, we do the best we can to help you. We have a library of tutorials to help you with. So I think it's very practical for someone new, but the material definitely would be more the medium level. So I'd encourage you to jump in with us over the next month as we navigate through this crazy market, and I think it'd be a big benefit to you. So thanks again for coming in today. Also, if you're interested in the retirement class income online class, you've only missed one. You can come in tomorrow. I think that's very helpful for those of you who want to get some income in your retirement account, but want to do it much cheaper or more efficient than doing a covered write or cash secured put, where you basically have to put up the amount of the stock, which could be very expensive. We'll be meeting tomorrow at 1 Central, and it's recorded. So have a great day, everybody, and we will see you next time.